As financial markets soar to new peaks, renowned investor Jim Rogers issues a grave warning about the potential dangers of the current economic climate. He highlights the bubbles forming in bonds, property, and stocks, while advocating for a focus on undervalued commodities like silver. Before we dive in, if you've ever thought about investing, the first link in the description takes you to Interactive Brokers, the platform I use. Introduction to the economic climate. The current economic climate is unlike anything seen before. With unprecedented levels of debt and asset prices soaring, caution is warranted. Many indicators suggest that multiple sectors are inflating beyond sustainable levels. Central banks around the world have adopted aggressive monetary policies. They have printed vast amounts of money. This has led to a distorted financial landscape where traditional measures of value are increasingly unreliable. Understanding the bond bubble. Bonds are currently in a bubble with prices reaching historical highs. Investors are flocking to bonds for perceived safety, unaware of the risks involved. The yield on bonds has plummeted, raising concerns about the long-term viability of this asset class. As bond prices rise, yields fall. This creates a precarious situation. When interest rates eventually rise, bond prices are likely to fall, leading to significant losses for investors. The property market, a global bubble. The property market is another area showing signs of a bubble. In countries like Korea and New Zealand, property prices have skyrocketed. This surge has made home ownership increasingly unattainable for many. Many investors are buying properties as an investment, driving prices even higher. However, this bubble is unsustainable. When it bursts, it could have severe repercussions for the global economy. Price increases are not matched by wage growth. Many are priced out of the market. Potential for a significant correction in property values. Stock market trends, the rising bubble. The stock market is also experiencing a bubble. Certain stocks, particularly in tech, have seen meteoric rises. Companies like Amazon and Samsung continue to climb, creating an illusion of endless growth. However, not all stocks are performing equally. Many are still undervalued, indicating a split market. This disparity raises questions about the overall health of the stock market. Identifying cheap assets, commodities. In contrast to the inflated asset classes, commodities are currently undervalued. Precious metals like silver are significantly lower than their historical highs. Sugar and oil have also seen drastic declines in value. Investors looking for safe havens may find opportunities in commodities. This asset class offers potential as other markets face inevitable corrections. Silver is down 60% from its peak. Sugar has fallen 70% from its all-time high. Oil prices are down 50%, presenting potential buying opportunities. Debt trends. Since 2008, since the financial crisis of 2008, debt levels have surged. Governments and corporations have borrowed extensively, creating a precarious financial landscape. This trend raises concerns about sustainability and future economic stability. Even countries like China, once debt-averse, are now heavily indebted. This shift signals a global trend where debt is increasingly seen as a solution rather than a problem. Debt levels have skyrocketed worldwide. Historical patterns suggest that high debt leads to economic crises. Future generations may bear the brunt of current borrowing practices. If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more. Potential crisis, who will save us? The looming economic crisis raises a critical question. Who will step in to save the day? Historically, countries have relied on their financial reserves or other nations for support during economic turmoil. However, the current situation is unprecedented. In 2009, China played a pivotal role by injecting liquidity into the global economy. They had significant reserves and could stimulate growth. Today, China's financial situation is less robust. Their ability to act as a savior is questionable. Other nations also lack the necessary resources. Countries grappling with their own debt issues are unlikely to offer assistance. The global interconnectedness of economies amplifies these concerns. If one nation falters, others may follow. The absence of a reliable savior could lead to dire consequences. In a world where everyone is in debt, the chances of a coordinated response diminish. This scenario raises fears of a cascading failure across financial systems. The likelihood of economic collapse. Jim Rogers believes an economic collapse is not just possible, but probable. The signs are evident across various sectors. High levels of debt, asset bubbles, and growing social unrest all point to a system on the brink. Debt levels have reached staggering heights. Governments and corporations alike are heavily leveraged. This excessive borrowing creates a fragile foundation. When the inevitable downturn occurs, it may trigger widespread defaults. Furthermore, markets are showing volatility. Stock prices fluctuate wildly, often reacting to news rather than fundamentals. This disconnect between reality and market behavior indicates instability. Historical lessons and social unrest. History provides valuable lessons about economic downturns. During times of financial crisis, social unrest often follows. People become frustrated with their circumstances and seek to express their grievances. The Great Depression is a prime example. Unemployment soared, and many lost their life savings. This led to protests and civil unrest across the globe. Today's society is no different. Anger and frustration are palpable. Moreover, the current environment is exacerbated by social media. Information spreads rapidly, fueling discontent. People are more connected than ever, making it easier to mobilize. This could lead to larger protests and possible violence. The role of governments and central banks. Governments and central banks play crucial roles in managing economic crises. Their actions can either mitigate or exacerbate problems. Currently, many are resorting to aggressive monetary policies. Central banks have been printing money at unprecedented rates. This strategy aims to stimulate growth but risks creating further inflation. As asset prices rise, the purchasing power of ordinary citizens diminishes. Governments, too, have increased spending to stimulate their economies. However, this spending often leads to higher debt levels. The cycle of borrowing to fund spending is unsustainable in the long term. The future, signs of economic slowdown. Signs of an economic slowdown are becoming increasingly evident. Analysts are observing shifts in consumer behavior and business investment. These trends suggest that the current growth phase may be losing momentum. For instance, consumer confidence has begun to wane. People are hesitant to spend, fearing future economic instability. This reluctance can further slow growth, creating a negative feedback loop. Simultaneously, businesses are cautious about expansion. Many are reducing investments and laying off workers. This contraction could lead to higher unemployment rates, further dampening consumer spending. Consumer confidence is declining, indicating economic worries. Businesses are scaling back investments, anticipating a slowdown. Higher unemployment may exacerbate economic challenges. For those interested in learning more about investing, I've had a positive experience with Interactive Brokers. The link to their platform is in the first link of the video description.